The most important mental model is the mental model of compounding. You cannot forget compounding. Be patient. And patience is not an IQ. It's not something that has to do with intelligence.
We are going to talk about applying things like ecology and neuroscience and sociology, evolutionary biology to portfolio management.
We have to be prepared for alternative futures. You're not even playing a Friday match. You're playing a generational match.
Welcome to our podcast, Tech Wealth Chronicles. First of all, I want to admit that this is something that I've been looking forward to for a very, very long period of time. It's great knowing you over a decade. But today, I'm both excited and a little bit nervous as well, because I'm in front of someone who is extremely well-read, extremely knowledgeable, and basically has done so much for the industry in terms of training, imparting the knowledge with current financial leaders and also the future financial leaders in the country as well.
There are many more people who have done very, very good things for the industry and for the sector and for investing in the whole. That it would be wrong on my part to say that I've learned from a lot of people. And this is just the expression of gratitude to everyone who's helped me.
Awesome. And then that's your humility speaking, Chetan. I first of all wanted to express my gratitude. But let me just start out by saying that when we think about wealth management classically, we think about traditional finance, we think about numbers, we think about balance sheet, we think about valuation, macroeconomics. I mean, those are the classical topics that comes to our mind. But in today's podcast, we are going to talk about applying things like ecology and neuroscience and sociology, evolutionary biology to portfolio management. So our guest today brings a truly unconventional perspective to how capital is allocated. He looks at markets not just through finance, but through the lens of complex systems and human behavior, combining these disciplines into a powerful framework for understanding the market and managing capital. So welcome to this 9th episode of Tech Wealth Chronicles. I'm your host, Malaysia. And today we have the privilege of hosting Chetan Parikh. As an additional introduction, has been rated among the India's best investors by Business India magazine. He's a co-promoter of Jeetay Investments Private Limited, a semi-registered portfolio management firm with thousands of crores of asset under management. His traditional finance pedigree is exceptional. I mean, he holds an MBA in finance from the Wharton School, graduating with distinction in the top 2% of his class, and a BSc in statistics and economics from University of Bombay, where he was a record holder as well. He also helps, and this is something which I have a personal soft corner for, especially what you do as a visiting faculty, shaping the next generation of business leaders at the Institute of Jamnalal Bajaj Institute of Management Studies. But what makes Chetan's approach to markets truly unique is the way he extracts mental models from outside the boundaries of finance, drawing insights from a multitude of fields. In today's conversation, we may not talk about as much when will Indian markets recover, when will FIIs come back. So we are not going to talk about many of those topics, but we are going to dive into this Charlie Munger style of lattice work of ideas to understand how investors can protect capital, spot hidden fragilities in the market, and avoid the psychological traps that destroy wealth. So Chetan, once again, welcome to the Tech Wealth Chronicles.
Thank you, Buddy, for having me. Thank you, Sejal, and thank you, Vanisha.
So let me start out with the first section of our podcast, and where we want to understand a little bit more about your journey, how your thought process has changed over the years. But let me start out with the first question, that you have been rated among India's best investors. When you look at your journey,
I think that's a misclassification. It's not, I don't deserve to be there. So it's nice to have that title, but the best investors have done fairly well, much better than I have over long periods of time too. So I respect that. I respect that everything that is put, but I don't think it's so much.
no, again, so Chetan, once again, thanks for that, again, your humble response to it. And I think we need to learn from you and many other investors who have done phenomenally well. But I want to ask you that when you look at your journey, right, and what do you think people misunderstand about what actually makes someone a good investor? So maybe we would want to understand what is the typical misunderstanding, because for me, it's not just about, the returns or how many economic cycles are you able to thrive or survive, but would love to know from you what actually makes someone a good investor.
I mean, what's made me at least survive in these markets and survive for, I think now, good long period of 40, 50 years, survive in the sense that I've done better than market indices and I've not lost my shirt. to some extent at the base level, which is valuations, which is market narratives. You try to keep up with that. But more and more, I am trying to get away from that. And I feel that adds to your strength in terms of being able to withstand these sort of changes. There are big changes that are coming now. I don't think reality can be understood only from P ratios or from discounted cash flows, because our basis of trying to figure out what the cash flows are going to be in the near future is going to come under more stress. The things that are required is, first of all, that I still believe is anyone who takes a short quarterly view of numbers is probably on the wrong path. My view, I may be wrong, but my view is that that's not the way to play this game. I think you ought to play for the long term. And for the long term, I don't mean what the Wall Street talks about, which is usually a year, which is considered very long term. And if you go up to 3 years, it is unreal. But if you start talking in terms of 10, 20, 30 years, it's like a different planet. So I think the first thing is to get out of this mindset of trying to outperform over very short periods of time. I think you'll make mistakes more likely than not if you take a very short term viewpoint, which is the myopia. And of course, there are incentives why this myopia perpetuates. The second thing I think is to be patient. And patience is not an IQ. It's not something that has to do with intelligence. There are guys who are very, very smart at the markets who have to be wise. You don't have to be only intelligent. Intelligence, a base level is required, but beyond that, it's all behavior. These are behavioral habits that you have to be born with or teach yourself. And if you don't, then you will learn. One learns through mistakes that if one takes a short-term view without doing adequate research or adequate homework, one is likely to run into trouble. So that's second thing. The third, so therefore be careful what game you're playing. You're playing the wrong game. I'm not saying there are people who have successfully managed to mix both the short term and the long term, but most people, at least I can talk for myself, I don't think I can do that. I just cannot do that. And it's therefore the third thing is to recognize what sort of an animal you are. Everybody is made differently. Everybody has had a different evolution and a different background. And it's not whether you have academic degrees, but how you've gone through life itself. If life is one where you want to practice resilience, you want to practice survival, then I think that the game you would play if you march by the tune that the market sings or the market players sing, I think you will probably get into, most people, at least I would get into trouble. I can't speak for the whole universe, but I certainly don't think I can play that game well. So that's the third thing. And so I think things like this temperament, patience, are very long and I'll come back to that. It was a long duration that you overthink in terms of you're not even playing a 5-day match. You're playing a generational match. There's a very different mindset from thinking of T20s and coming now with thinking in terms of decades. And nothing is permanent, but I think that mindset of thinking beyond the immediate here and now and the immediate 5 days of swing is very, it's the final thing was being able to adapt because situations change, world changes, and it's just changing at speed now. I don't think that you can take anything for granted. That's why I'm saying no proficiency, go for resilience. Resilience is far more important. Resilience means that do not get out of the game. Figure out ways how you can get out of the game. I know if I took leverage and I succeeded a few times, I would take more leverage. And more leverage will kill me. So what will not kill you is what we want to figure out. Excessive leverage, excessive trading, excessive listening to noise, and also I think for a long-term investor, it's absolutely dysfunctional. It's not even, it is dysfunction. You will not function well if you have three different streams coming into your mind and body. And I keep repeating that recent success has been nothing. This is not the aim of trying to beat someone in 3 months or 6 months. evaluate your track record over very long periods of time. And the first thing is to survive that. So if you are going to be in a game which makes you uncomfortable, then sleep in the night. I don't think that's investing. That's actually a form of hyper competition.
So these are really wise words. I think it's, you rightly pointed out, I mean, a lot of our audience are actually in tech sector. A lot of our audience is primarily the leaders in different technology companies all around the world. Many of them live in India, many of them live outside India. And I think one of the things that they are very hyper competitive. But I think to your point, I think what today's investor really needs is a long-term outlook. Try to be away from all the distractions or dysfunctions, as you are rightly calling it as well. Avoid the noise, have patience, and then clearly be aware of how to play the game and how to even get out of the game, right? And if it is not to your liking. So I think amazing wise words taken over there.
See, it's easy for me to say this. It's very easy, but it's very difficult to practice it. This is the one place where I can say patience. I can talk to clients about long term, and the moment there is a drawdown, they will be phoning me up and saying, what's happening? So I think that is a human impulse for action, for quick feedback of things which are highly complex. You cannot explain it in make a minute or two what's happening to the markets. I think there's a it's even salacious to try to explain this because this is noise. If you're thinking in terms of structure, you can't get distracted with all this. This is not really important. If you're leveraged, if you're trading, yes. But if you're not doing that part, you're out of it. You can be patient.
And you're right. I mean, it's easy to say, but hard to practice. I think we have seen drawdowns of 2008 period. We have seen drawdowns of 2020. We have seen even of dot-com bubble, and maybe you have seen even more. But I think the one lesson has been clearly being patient, understanding what is really driving that change, and then trying to step back and look at the bigger picture, right, as opposed to reacting in the moment. So I think that, of course, is a very, very wise advice from your side. But let me ask you something just from a markets perspective, right? And I personally am a student of finance. I've done my MBA in finance, and finance for me, all my life was all about numbers, was all about skills, valuations, etc. But was there a moment when you yourself realized that markets can't be understood through finance alone, that you needed actually psychology, ecology, multiple other disciplines to come together to truly see what's happening out there? So just would love to hear your moment of reckoning, right?
At the moment when it happened, when I can say that, as one kept reading, especially the letters of Mr. Buffett and the talks of Mr. Munger, you slowly came to realize that there are mental models or there are frameworks you have which may not apply with change. And you got to be able to adapt to those changes. I mean, person like Mr. Buffett was a diehard. We had, and he changed when he had discussions with Munger. And he became more, I would say, you don't want to put labels on value and growth, but he became a person who thought value could be redefined into this kind of intrinsic value, and intrinsic value calculated through both of the DCF, etc. And I don't think that Buffett has frankly done any great DCFs, but he thinks in those terms. It is a cheap innovation. That's the whole question. It's not just numbers, it's a philosophy of thinking. I would suspect that anyone who's trying to do a DCF, anyone, not a theoretical exercise, but a practical exercise, will realize how difficult it is to do a DCF without great amounts of sensitivity, and then which ones to go to, what probabilities to apply into the future is something that is not easy. I'm not saying it's not possible, but it's not easy. And you can make large errors. If you make a little error in growth rates, you can go from the sun to from Mars to move to Mars. So it is a little change in growth rate assumptions, and things change. And you can't understand this only by putting the spreadsheet. You got to go behind. And it is not the short term sort of events, because each event is dependent on many others. It's what Mr. Munger had once recommended. And I have taken that to heart. And this is a book that he's recommended. which three scientists have got. And this is a book which written by Robert Wright. It's about one so-called scientist got my, and that was Kenneth Boulding. Kenneth Boulding talks about the hierarchy of systems. He talks about the fact, and I think somewhere even Mr. Munger has talked about it, that there's first just a very, very basic substrate. And then you go down to higher substrates. So you start with physics, and then go down to biology, chemistry, biology, the other sciences. And then you come into meaning systems. You come into psychology, you come into social sciences, other social sciences, which allow you have to use the basis of that to be able to understand the changes that are happening in the higher systems. And the higher systems, according to Boulding, ends at at transcendental systems. But you can just below that is a whole amount of systems which have to do with markets, with so this whole framework of looking at systems, nested systems, these are all nested systems. The higher one depends on what happens on the earlier one. So human systems, animal systems are there before that. So you have to have ecology, and if you are trying to understand the entire thing, you have to understand sociology if you are trying to predict what is happening at the mass levels. If you are looking at changes, fashion changes, and not trying to say, but you will not understand it only by looking at what's happening in the shops. Maybe if you want to take a short-term view, if you want to ask beyond that, technology changes. I don't think it's going to change, but many people assume that technology is not going to change. And when you make that assumption, your DCF and everything becomes highly vulnerable to changes. The second thing is your time duration, because your time duration also varies. And that is something that I think that a long time back, I think in the 80s or 90s, I don't remember when exactly, I interviewed for Capital Ideas. I had the good fortune to interview Dr. Mark Faber, Bloomberg. And he's a profound thinker, in addition to being an amazing practitioner and commentator on what is going on around the world. And he recommended that also. This is Bernard Brody. He's a French thinker. There is a historical that school which and then where he talks about three time horizons. One is the event horizon, which is extremely short term, which is what our traders do, etc. It's a short term. Looking at that. Beyond the events are cycles. That is something along the lines of what Schumpeter talks about. About your cycles. Schumpeterian cycles is a well-known name, a well-known phenomenon in economics. So there's Schumpeter's. But beyond that, if you think really long term, it is the longevity. That is the long duration cycle. What happens? And that is all about structure. It is not about events. And each is nested on the other. So if you think events by itself, you start with the shortest time frame, but you want to come to understanding structures. What is happening in structure over long periods? And that is beyond that, demographics is also a lot to do with history. It's a lot to do with the geography, where it is. You're not going to be able to understand what is happening today, let us say, between the US and Iran.
Of course.
Iran without understanding. Now you'll say, but what is the relevance? Today, I can tell you a lot of people are trying to figure out, and maybe it's a short-term thing, but I'm just saying short-term. You can try to figure out what is going to happen to how long will it last. I don't want to get into my theory of that, but I'm saying you'll have to go behind what is happening, to Iran and Israel today to try to figure out how long can this duration last, how much can oil go up to. This even from the short-term point of view. I'm not even talking. Long-term, it may be irrelevant. It may be absolutely irrelevant. But short-term probably would be the thoughts by people. So you'll have to rely on these sort of temporal things to be able to get any sort of. So reality, you can talk of reality, and I don't want to get philosophical because philosophy sits at the highest level. I'm saying forget philosophy. And if you say, okay, I'll do a DCF and I'll solve my problem, I've got an intrinsic value, I'll publish it in my report. And if you talk of you need to know much deeper. And then that is what Dr. Mark Faber, always, he mixes charter. He's a technical chartist, so it's not like he's
Oh,
talking
wow.
of, but it's amazing that you need to mix to understand and a multidisciplinary viewpoint because there are nested systems which comprise we think is reality and our perception are extremely focused and narrow that we line ourselves up to a lot of things that are what we think is irrelevant to our calculation. And that depends again on your duration. So your duration is something like which is in the next 5 minutes. I think we're reading all this. Absolutely.
I think this is a great perspective, Chetan, that the time duration really matters for investors. So they have to think beyond just the finances and the numbers. I think that is clearly the message. And I think you had some great recommendations from a book's perspective as well. Let me ask you one thing, Chetan, is, we love Capital Ideas Online. And it's not classically about just the state of the market, etc. There's so much kind of diverse topics that you bring together and bring out a perspective. Love all the letters, but where did that idea really come from, right? I mean, in terms of starting Capital Ideas Online and putting the type of content that you actually put out there.
Didn't start it. Let me be frank, it was started by a person who is today a well-known prop book. He's worked with a number of institutions and he started it. And this was when he was very young. This Avinash Vatva. He started this and then came on the platform too. And it was amazing because then there were a lot of good thinkers who initially joined the platform and we were able to build it up. It was done with the idea of knowledge exchange and with the idea of trying to think outside markets and try to understand the reality that goes beyond. And it's also an intellectual exercise. It was not just that would help you to think back better. Remember, things are becoming more complex. They're not simplifying. And using one little lens of saying P ratios or EV to sales, that made a strong thing. So actually, this was done with that briefing. And it's developed, and I just done it. Sent the team. They're all contributors. There's nobody who's taking any monetary compensation from this endeavor. All passionate about just sharing what they know with a broader community. Maybe every contributor up over here, and you can see the whole list of them on this side. There is not the question of trying to create market value or create some sort of, it's more about trying to share what we know and to build a community of like-minded people, who understand that reality is really multifaceted. And if you have the view of trying to take a long-term position on anything, you probably become a better decision maker if you ask a lot of different questions. Because just thinking what the consensus, what the narrative is at that point of time may mislead you. I'm not saying it will mislead you, but it may mislead you. And you need to have those filters against money. That's a book that was written by Garrett Hardin. What are the traps that can come when you don't ask the right questions?
Right questions. Yeah.
And the question is, as Mr. Munger said, often avoid stupidity. I think the first thing to do is to avoid stupidity, and if we do stupid things, we can't expect great outcomes. The thing is, I think the first thing is a very negative list. It's not to become smart, it is to avoid being dumb. Because in the markets, everyone with a short-term stopwatch sort of thing tries to be very smart. And only a long-term thinks the tendency like, I don't want to play this game. I don't have to play this game. I'm beyond a matter. So why should I start doing the sort of things these people are doing? And if you have prop book, if you have a prop book, if you have patient capital, I'm not saying that people who are working for institutions can do that. They cannot because they are engaged by a set of metrics which are extremely short. I think that's wrong for the investors who are giving it. But that's the way they're aged. So, incentives again matter up whether they do what they are paid to do, right? But I don't think that's the way to play the game. So you can afford if you have a patient capital and a long-term point of view. And you're interested in other things. Because when you try to do a very, very long-term patient thing, there's every chance that you'll get bored. And boredom is something that can eat into a person if he doesn't know how to handle it. Boredom can be very useful, but boredom can be destructive. And I think that you want to understand where you have to be when you're bored. It's like Mr. Munger said once that it's like taking a flight. There are periods of excitement and periods when you either gain up or coming down, but there are long periods of just moving. And being bored is not a human. Humans are short term. We are not wired to be bored and to desist from action. Human beings are not wired for most of these things. Our brains are get very, very different because the environments in which we live, as everyone knows, that our brains evolve very different from this current environment. That's all I have to say.
Yep. So you do talk about, Chetan, the long-term outlook, and you, of course, are a great student and a great proponent of both Munger and Warren Buffett as well. But even Mr. Buffett himself also, when he took a very long-term outlook, he said he kind of revisited his old assumptions. So I'll ask you a personal question, like if you have to like revisit what you really strongly believe 20 years back, right, and which you don't think is something that you are willing to revisit those assumptions, what would those be, from your personal perspective?
Because they take the assumptions. There's some that will not change. They invaded, to use a word of physics. They invaded the fact that I don't want to lose money. That is the first rule I follow. The Buffett rule, which will never change. Rule number one, don't lose money. Rule number two, don't forget rule number one. I've gone through many experiences, which my late brother and I, it sort of fortified this, that we are, first of all, it's return of capital, not return on capital. And if you take that view, that you have a capital and you want to grow that capital, you just don't want to lose money, because the moment you lose money, you are getting. And I'm not distinguishing between permanent loss of capital and drawdown to
Sure.
But I think permanent losses of capital, where you want some rates of return over long periods of time, has to be protected. So I think that's the thing which I will not change. I will not change this thing of looking for moats, although finding moats which are durable and which will last for long periods of time is becoming increasingly challenging. And the world is changing fast, cycles are becoming shorter. And so I don't think that it's going to be easy to do that. That's why I'm saying that it's good that this was 30, 40 years back, because today it would have been extremely challenging to find companies, co-founders for long periods of time. Certainly, the next generation will have a much, much more difficult time than I have. They'll have to stabilize, first of all, a philosophy. Maybe this philosophy will not work. You must be adaptable enough to be able to junk it if it is not working. For me, it's worked up to now, but there's no guarantee it will work in the future. And the whole idea outside this is to be able to get away from markets and to be able to say, okay, what do I want to retain? What may have to change is this philosophy that you want to buy things really cheap, that or you have to buy them cheap based on conventional metrics. I'm not saying get into narratives or get into a narrative mode where you say, okay, there's a store, there's a store. But I think more and more you will have to try to visualize futures in an intelligent manner when you have to create ranges. You may say this is speculative, but I think that we cannot, in markets, get away from speculation. You may try to stick as much as possible on the investment component, but when history itself is becoming so short in terms of trying to see what changes, the whole idea of going back to history is, of course, to understand deeper forces, but more importantly, also to be able to have some predictive power. If things like reversion to the mean start falling apart, if you cannot have reversion to the mean, if you cannot have traditional valuation metrics capturing business models that are on the mind, they're not based on physical infrastructure alone. And there are big transitions. I mean, I'm not talking of small transitions. There are very big transitions that are happening with AI. Not saying physical infrastructure is not important. It is very important. I mean, batteries, anything that you do will require a physical substrate. But it will not be the only thing that will determine the modes. So that will have to require a rethink and revisualization, that you may have to buy loss-making companies with really not much predictability and be able to assign some sort of probabilities to the future to bring margin of safety there. Now, the whole concept of margin of safety may be absent because it will more be more like a VC bet rather than value. So all I'm saying is that we have to be prepared for alternative futures. I don't want to label myself as a value investor or any such
Of
investor.
course. Yep.
I'm
Yep.
a flexible person. I have stuck to a philosophy which has worked well for me. I am ready to accept the fact that tomorrow it may not work well for me or for most value investors. There's a lot of things that remain invariant, but there are many things that can change. And I'm ready to, first of all, I'm ready to accept this, that this may change the idea. And I hope, frankly, I really hope I'm not, because it's very difficult to change one's mind.
Of
Confirmation
course.
bias, all sorts of human psychology comes with.
Trappings come into pictures.
I don't want to fall prey to that knowing fully well, but it's impossible for a human being, knowing the biases that he may be incurring, to actually change his viewpoint. It's very difficult. Not saying it's impossible, but I really don't know easily how to do that.
So, Chetan, you do talk of all the mental models and not falling into the trap of human biases. And that's one curriculum which is extremely popular with a lot of students, both in the past and even now. So, if investors could just master like 3 mental models, right, to survive the next decade and like envision the kind of the future that they should envision, what would those be and why? I know you talk about lots and lots of mental models, but we are just trying to say that, hey, these are the 3 top mental models that investors should definitely master, especially to survive the next decade.
So I mean, if you still ask me, I would say that the most important mental model is the mental model of compounding. You cannot forget compounding. And if people who forget compounding are asking for big mistakes, because there is a point where you can try to optimize for short-term returns and forget about. There's a thing in finance also, which is generally true if you apply it unintelligently, that the greater, I don't admit to the finance version of risk, but it's generally true that the higher the risk, perceived risk, the higher the return. I would say the other way around. Now, these are things, yes, if there's something that looks highly risky in terms of, let's say, forget what happens to markets, but a wide variety of outcomes, a wide variety of things that can go right or wrong, there could be a fair amount of confusion as to what actually to do. And these are the six. I think that will happen a lot more in the future. The technologies are changing. And the skill will come out over there in being able to identify them and to be able to take advantage of them. So the 3 models, I mean, if one had to put a gun on my head and say these 3 models, forget about. I can't forget the rest, but I would say certainly reversion to the mean, etc. Probably things. It may be useful for navigating markets, but I don't think these are things that will help you to identify outliers in growth stocks. I would say that things like complex adaptive systems, things from there, non-linearity, asymmetric upsides. These are models that one should try to focus on. I'm not saying take them as options, but I think that you've got to understand that the modes that we are talking about, when AI modes are going to be crawling over the net, are going to be a little different. Ultimately, it's what humans are going to consume. But if AIs are going to start taking decisions on what's are going to start taking decisions on what humans consume, unless you reach right down to the consumer and tickle something, with all those gatekeepers being in place, is going to be a little more difficult. So I would say that that's the first thing. Second is the power of networks. You got to understand or try to figure out networks. That moat will be very strong in the future. And there will be more than in the past. There is going to be, because of that, a lot of, what should I say, switching costs. Networks can become the winner take almost everything sort of phenomena. The power laws will start working there. The 80-20 rule will start working over there. And so this is, from my point of view, this is the change that I think is going to happen. So previously I would have said, understand a lot of psychology, and I still say understand. So I'm not trying to, but I'm saying understand also technology, because technology is changing and technology is going to change a lot. So we cannot ignore things that come straight out of technology and systems, which is power laws. So this is what I feel. Forward-looking models mental models will be far more different from the models of which we have used and which have served us well in the last decades.
Awesome. So clearly, yeah, compounding power of networks, learning about technology, associating.
Adaptation is very important. And I don't think if you cannot adapt as, biology teaches you and as complex adaptive systems teach you, if you cannot adapt, Darwin said that a long time ago, you won't survive. It's not the cleverest that's a bad, it's the most adaptable of the species. That's in an ecosystem which is changing as rapidly as it is, being able to identify keystone species, the biggest species, which is what technology platforms allow you to do sometimes, but they can be destroyed. I mean, extinction events can happen a lot faster. That is going to be, I think, a very important part of tomorrow's investing. I don't claim to have any circle of competence in these things. I don't. But I am open to learning and I'm open to say that what had served me well in the past may have to change in the future. I hope that I will not redefine my brain too much. But the younger generation, probably the next
We
generation,
need
will
to.
be the clean state as far as the is concerned.
Chetan, you have written about optimization preceding failure, right? And in past, we have seen organizations, once they build a certain size and scale, like constantly optimizing and through that being able to retain their moats and generate more value. But where today do you see that systems that look dangerously optimized and potentially a signal for like maybe their ability not to be able to adapt and hence maybe fail in future?
I think that the first system that I keep repeating this for a long time is the financial system. I think the financial system is highly levered. There's a lot of debt in the system. There's immense debt to actually wipe out many years of returns. This time, I don't think it'll be like the past. There's a limit to the money printing that governments can do. I suspect that this time there will be government losses of capital that will come if deposit holders have to bear the cost and not taxpayers. If deposit holders have to bear the cost of any financial crisis that comes from volatility or from bad decisions, and given it's a network system, you are going to find permanent losses of capital. We don't think about this. We think because there are calm times and nothing has happened, the recency bias comes in and you say, oh, it's all going to continue. What's machine? I'm not at all sure about it. So that's a system which has been optimized for getting the maximum return with the minimal owner capital. That's a dangerous system. It's not a viable system in the long term. So I think that's one. There's no resilience in that system. The other systems, I think, are supply chains, which now seem to be becoming unwinded. They are unwinded because each country is trying to build up its own security, its own critical security. So I think that's the second thing. Third thing is we are creating technologies which are optimizing things right now in terms of what will require huge investments in the future. When everyone talks about AI and the sort of investments that will be required in the future, and saying forget returns, I think it'll be a daunting task for most people to be able to make those sort of investments commercially. So these are things where I feel there is too much focus on the short term and not enough thought about resilience, about how they want to be able to take this if things crash, if systems crash. How are we going to be able to? And maybe there's a philosophical question and people say it won't happen. And maybe it won't happen. I don't know. But I would always worry about things that can go wrong rather than things that serve me well as an investor to keep focusing on what can go wrong rather than only what can go right.
Yeah. And clearly, I think you have also talked about Nassim Taleb or the fragility of events, and we have survived 2008 cycle. So
Another piece of amazing thinker, and I respect what he writes. I think there are many thinkers like that. Schilling is a thinker whom I respect a lot because he brings game theory into thinking about economics, politics. I think a lot of other subjects. So these are all people who are multidisciplinary. And today, I think that there is a need to think in a multidisciplinary manner. You can't just think of one model and say, hey, this is the way to work. But this is the way it's going to work. I don't know what Frankly, even after doing all this, I'm not so sure. I don't think anyone is sure, and anyone who makes 5-year, 10-year, 20-year forecasts, I would take them with bucketfuls of salt. I would take them with a pinch of salt because these sort of assumptions about what incomes will be, about what growth will be, assume that your systems are going to remain. You see, they are assuming things will linearly, and linear thinking in this world where there are feedback loops, there are all sorts of discontinuities that can happen. I think is the most dangerous illusion to have. So I think, and when I say you're a philosopher, you're thinking like a philosopher, what do people who are acting do? Well, I think that you keep on acting with a certain amount of humility that the world may not be the same. And keep on acting with the best of your rational thinking.
So, Chetan, you rightly mentioning that the world is becoming uncertain. There are certain systems that we are assuming will keep going on, but it's not necessary that those systems, whether it's financial systems or supply chain systems, will continue to provide that extrapolation which most analysts or investors are currently doing. But I want to get on to your previous point on to the durability of companies' moat. Of course, as you rightly mentioned, moats are becoming more and more difficult to identify. And you have also written about the neuroscience of consumer behavior, distinguishing between narrative modes like Apple or LVMH and habit-based modes like Visa and Coca-Cola. So when you are analyzing any business bottoms up, right, in today's time, how do you determine if the company has true, durable habit mode versus maybe just a product that is riding on a temporary, let's say, a dopamine-driven narrative bubble?
And I'm not an expert on psychology or on what drives consumer behavior. Like, there are certain habits which bring in a behavioral lock-in to my mind. And those lock-ins can work for some time. And one has to reassess whether that behavioral lock-in, as there is a demographic change, whether that behavioral lock-in, or even an income change, there's a geographical change that is happening. Regional changes, certain regions are coming in as more powerful in terms of consumer behavior. I don't know whether we can categorically state that what we have assumed in the past about growth is going to continue in the future. And in the end, you have to always correlate in markets what you are paying for what you're getting in. If you are paying a lot for what happened historically, you have to look at the valuation in that equation. Because in the end, valuations do give you comfort. Even if you're wrong, you don't lose a lot of money. That's the asymmetric part of investing. If you are wrong and you don't lose a lot of money, I think that's a sweet spot to be in. If you are wrong and you lose a lot of money, I think that's a dumb bet. So it's not a very smart bet. Even if you have a long-term view, you will have some standard rates of return. And that is as good as losing money. If you cannot earn cost of capital, your cost of capital, and then there is technological disruption that can happen. So the way to look at these modes is to see whether there's a deep habit that are being built in. But be prepared to change that viewpoint, that the habit may change also. There are a lot of modes, like Apple, I would say, has a certain share, there's a certain design factor, which is a certain social proof that others are using it. It has a certain lock-in when a whole app system has been built around it. So I do not think that Apple's mode can change. Obviously, technology has made a lot of things redundant. I mean, you've seen what's happened to the smartphone industry before Apple came in and after Apple came in. Because Apple came out with a lock-in system. It created a whole ecosystem.
Network.
The idea was to create a system, an ecosystem, which the other guys had not done. So I think that's where the genius came of Apple. And then there is just a part dependence that sort of builds up, and they did it. I don't know with AI, with a whole lot of things happening, whether that will continue or not. I'm not trying to say that it won't happen. I'm just saying I would want to see how it progresses. So these sort of have to distinguish. You have to see ultimately whether the sort of effects that you're talking about creates that, as Mr. Munger said, not a desire. You have a whole bunch of modes reinforcing each other. And if they're strengthening, you're probably in a sweet spot. If they're weakening, then you've got to be careful, especially if there's a high price. I'm not saying flip the stock out. That's not the way, but to examine more deeply and then put degrees. I would use the word degrees of discomfort. There's a degree of discomfort, and then you want to keep weighing that in your mind. This is where I'm saying that, looking at screens won't help you. Your probability judgments will come much more if you read outside, if you read what experts in the field are saying. And for every plus, you look at a minus. If every bull case is there, you look at a bear case. And somewhere between the two, some reality hopefully will come in. And if you can't, then I think that you have to be careful of holding the stock because you cannot form a view. And if the valuation is not in your favor, I think that you want to be very careful where you're trading. Valuations remove a lot of that uncertainty because the valuation was low. That's the worst that can happen. Then I think that makes sense. You can take that. That's the asymmetric thing.
Right. So you have argued about modern institution acting as a collective cognitive machines, right, which inherently generates some blind spots. So for a wealth management firm who is trying to allocate capital safely, what are the biggest institutional blind spots that you see today? I mean, whether it's in Wall Street or in Dalal Street, and especially how do you train your team to see the risks that, the broader financial kind of the thought collective is ignoring?
I mean, I tell them to look at all narratives carefully. The narratives must translate. We must be able to make sense of what you're doing. And if you get into any narrative, I think they're making a mistake. The second thing I tell them, this is my training, but they may now have to probably discard it. They're a younger generation of, I think in many ways smart with the technologies that I'm not at all familiar with. But I think they will have to think in terms of downsides. I mean, only upsides I see was a little dangerous, especially if it's longer to the future. You have to look at how much you can lose if you are not right on your path. So that's a second discipline that I tell them to do. Narratives can stir up, a story can sound very exciting. It can, juice you up, especially some investment banker is pitching it, and some very well-oiled business team is marketing it. You can get swayed. But then remember, I might be getting my own blind spots in this. May therefore caution them that whatever I say is the weight of maybe 25, 30, 40 years of experience, which may not, and I repeat, not be relevant to today's times. So you must be flexible to change. I'm ready to change, provided someone can put very sound reasoning and we incrementally increase the size of the bet. Because to just jump into something you're not very sure about without testing it is, I think, also dangerous. I keep on saying, think long term, because if you lose a small amount of money, maybe you can attribute it to tuitions. You lose a lot of money, and then it's not tuitions, it's painful. It is actually a lesson. And if you're managing other people's money, it's an even greater. So I tell them, very careful that permanent loss of capital is something that should not be acceptable. And we must guard our capital, even if we give some subpar returns. Even if the returns for the short term are low, because you're doing things out of sync with the market, it's fine. But if you start buying things without things like market psychology does not change. I believe that reversion to the mean as a theme may disappear or may go away. Right now, it's easy money, which I think is popping up a lot of valuations. But these are economic forces right now that may cause this entire easing of money supply to disappear. We are seeing it. We are seeing geopolitics play out. So I just told them be careful because, as Mr. Buffett said, which when the tide runs out, then you know who's swimming naked.
Yeah. I think, again, great lessons, Chetan. In terms of also training your team and watching out for each of those blind spots. And again, the important principle is thinking in terms of negative, like what gives returns rather, what can go wrong and where you can lose money. I think thinking in from that term, again, very, very strong thing.
When you invest, only look at upsides, you are forgetting the downsides. You're big mistakes. And you can't look at a bull story and forget the bear story. And reality is just that look at it from different perspectives. Just don't look at it from one perspective and say this is it, because the human mind has ways of taking shortcuts. Therefore, I think being patient, writing down things, putting things on paper, and frankly, having somebody who can argue against you, argue not points of view of getting into a violent clash of personalities, but getting into a violent clash of
Of
ideas.
thoughts. Yeah. Thoughts and philosophies.
That is a good debate. But if you start getting into personality issues, that becomes a
Yeah.
bad.
So, Chetan, you have spoken about incentives also dominating ideology. And as you rightly mentioned, there are fund managers, wealth managers, venture capital funds, etc., currently operating potentially on certain incentive structure. But what are those incentive structure that you think are distorting the market the most? And what's something that people should be cautious about?
I think that, first of all, it's extremely short term. Unfortunately, that's the way people are remunerated, especially if you don't have large AUMs. You are pushing for assets unless you have your own prop book. Most people don't have their own prop book. So I think that to survive in this market, you have to get fee income. And the way to get fee income is to get AUM just to sell stories and also to sell performance on a 1 month, 2 month, 3 month, ridiculous time frames over which people are taking the skill of fund managers. I would say that look over time horizons when a guy is able to keep your money in survive. If he cannot survive, if he's going to take risks on your money, we are in deep trouble. You're really in deep trouble. Now, there is fortunately no leverage at the fund management, but we're not allowing all that. But
True.
yeah, I'm not sure what they're doing there. I don't study this because these are structures I want to keep away from. I would
Yep.
rather people who come with patient capital and tell me this is how we want to build wealth generationally. And I don't want to go and at least my team will do whatever is necessary for Jeetay. But personally, I would not like to go into things. And frankly, at this stage of my life, there is really no necessity. I want to
Yep.
reflect on what I have done and what may change and give those thoughts to the team.
Chetan, how do you see importance of identity in investing, right? I mean, does seeing oneself as a value investor, growth investor, you know, these days people also talk about momentum investor. I mean, I don't know, those seems like conflicting terms, but do they create like a lot of rigidity traps?
It leads to a lot of rigidity. I think it leads to a lot of blindness also. You get blind spots with your identity. One thing is obviously you get discipline too, because you say you're a value investor and you behave like a momentum investor. There's a poverty mismatch. In the end, you have to reframe everything, right? I mean, if as Buffett reframed it, what is value? What is growth? Yeah, giant at the head, right? I mean, I think changed a lot of perspective on what is value versus what is growth. I think those are nonsensical sort of
Classifications.
classifications that fund allocators look at to pigeonhole people. And I think it's not the way you want to be pigeonholed. Just as they pigeonhole people with betas and alphas and what else. So I think that's wrong. It's just about keeping capital, compounding it over a period. That's my view. And it's not the view that you will get availed from. Because in the end, if that's the idea, then you better follow what the people who allocate capital want. That's your customer base. Right? So you want to do it, it's a business. And it's a business and not a profession. There's a difference between a business and a profession. It's a
Yes.
business. Then you have to do what your client wants you to do. If it's a
True.
fashion, you do what is right, not necessarily what the client wants you to do. There's another book I saw this, and I would seriously suggest that this author is good, and it was given to me at a conference in Dubai, and this is the book, Gaining Long-Term Gains. This author is good, Dubai, and it's actually a book which I believe he had even Guy Spear has put up forward for this book. But this was given to me, I didn't buy it. And I think that the most important thing he's talked about is, I think, the distribution of outcomes. The first thing about survival is about survival. It's about what are the situations which can get you. So just going by the mean or by the standard deviation number may not be enough. You want to know which outcomes can actually cause a mortal risk
Hmm.
to you. And that means you get out of the game. If you take leverage, if you start buying illiquid stuff, which you have no competence in, you don't know how to exit. If you oversize your positions, these are
Yeah.
all you would get out of the game very fast. Or maybe not fast, but ultimately you will get out of the game. It's like playing Russian roulette with 5 bullets. I don't think you can survive in the game. This is it. I think that these are things I'm trying. At the same time, we are trying to grapple with a lot of change, which we may not, at least I have not experienced before. The change that is happening on technology, the change that is happening in terms of social systems, the way fragmentation is happening. We've gone through a long phase where there was this one theme of globalization. Today, the globalization narrative has fallen apart. And you're now
Right.
what I would use the word, there's a beautiful book called Sultan Exile Economics. It's about
Mhm.
the and supply chain security. That's a change. That's a paradigm.
Correct.
That change was certainly a big change. And we got to realize that somewhere history on very long cycles is repeating itself. But you're getting a situation which is akin to the 18th and 19th century where there was great power, rivalries, etc. Now, if you go back that much, you'll realize a lot of what you're seeing today is actually a playback. It's a playback to those days. And it's in a different actors, but you can actually drop parallels. So it's interesting. And so I keep telling them, look, this is multitude. You can't say this is the answer, this is the thing. First, destroy time horizon. Yeah. If I make for the
Right.
long term, then behave like a long term investor, not like a sprinter, not like you're running a marathon, you can't sprint. You'll get tired out. You absolutely get tired out. So I think this is where the difference comes in. I remember people who guided and mentored me, people like Professor Tarapur Varna,
Mhm.
these are people who thought from long-term perspectives. They did not think 3 months and 3 years. They talked about literally buying a company for keeps. That's
Right.
obviously good also because you're not
Right.
going to find companies that may last for that long with superior return on capital. Right. Nice philosophy.
So, Chetan, for our audience specifically, I also kind of want to provide them the practitioner's playbook, and especially in terms of asset allocation, right? If I were to look at it, I mean, should it change meaningfully? Let's say again for a long-term period, let's say for the next decade or even longer than that, like maybe 2 decades, 3 decades, etc. Should it change meaningfully across all these economic regimes, or should it remain structurally consistent? What's your view? I mean, is asset allocation kind of, in some sense, carved in stone? Because we all tend to follow a certain framework and say that, okay, how off you are against that framework. But should that framework itself change with time?
I feel that that's a very important question, and it's a question that one has to grapple with because if there is change that you can see, you cannot say that I will stick to this asset allocation formula for all times to come. At the same time, I do believe, and still continue till evidence comes to the contrary, that over long periods of time, equities will generate wealth. So I think that the asset allocation bit, which is structural, which is what equities have given long-term superior rates of return to most assets. If you are able to go through survival crunches, which is where companies can fail, where disruptions can happen, if you can go through that, equities have given superior rates. So that's history issue, no point to argue about that. But there are times when things change. Extreme valuations come in, big disruptions lurk around the corner. Then if you are anticipating that or you're seeing that that can potentially happen, it makes sense to de-risk part of the equity exposure because equities can get in those regimes,
Right.
equities seriously underperform. And underperformance may not mean much, but if there are existential issues about the system itself, then I think that it pays for investor to look at things that can actually benefit from fragility, anti-fragile sort of systems.
Right.
So, if you would ask me in recent, we have made a long time ago an allocation to gold. And that was just as an anti-fragile move to equities, to paper assets, and we did it from the propriety perspective, not from the point of view of trying to maximize some return. It was just a loss prevention mindset. Now, we don't want to lose a lot of money. And if equities fall down in the sense that there are disruptions that happen, be at least. So it was really a tactical shift. It wasn't a structural shift that we were making. I still believe anyway diversify our asset
Of
mix.
course.
But I did this only from the point of view of trying to actually gain from disorder. If you have fragility that you see, well, you want to gain from disorder. And which is the asset classes which can gain if things start falling apart? We thought it was gold, not Bitcoin. But I stand corrected there too. I mean, who knows? I had not foreseen this sort of a violent development. Maybe it'll still end well, but I don't want to comment. This might go and they work differently. So I would say yes, there was a layer which is strategic, and that's a huge layer. It should be strategic, and there's a part which is tactical. You got to be able to change.
Yep. So flexibility, I think, is still critical.
Whatever you want to call it, I would say adaptation.
Yep.
Otherwise, you might face extinction movements. In ecology, there are invasive species that come in. There are, species where the climate changes and a whole bunch of organisms die. And if you take those lessons from ecology, you will realize that the most important thing is to survive. The one that has survived, if you ask about the species that survived the most, it is a cockroach. The cockroach has survived a long periods of time. Why? Because it's been extremely cautious. They've been able to adapt to the environment, whichever environment it's in. So Darwin said it is the most adaptable of the species that survive, not the quickest, the fastest, not the smartest.
That's very interesting.
And that's only one way you can be adaptable is to be really, know the limits of what you don't know. There's a lot we don't know. There's really a lot we don't know. No matter how much you read, the best thing is to realize no matter what temporary success is, ultimately what counts is the survival. Survival is really the final test.
So Chetan, when you allocate capital, right, do you have like a decision-making checklist? I mean, some of this, of course.
Checklist is so short of checklist because I think my team will not be able to sit through very long periods of trying to fit it in. But there is an investment thesis that is based on that checklist, which is anyway done by them properly. When we come to the checklist, it is on things like the degree of certainty we have, because we can't say for sure we understood everything. But obviously, the first thing it starts with is, are we understood the business well enough?
Business, yeah.
We understood the business. If we haven't understood, there's no point pretending we have when we haven't understood it. It's important to be clear about that. It's just a very complex business. Some people may have an edge. Those who have domain expertise will probably have an edge. We don't have domain experts. And so we would probably, at least I would probably, I don't want to learn something which I have no real interest or edge in. The next thing that needs is efficiency, capital. It's not just the capital efficiency, it is not just the returns, but how much does it need to earn those returns? It keeps on sucking in cash. You keep earning that to us. It's not a great business because ultimately competition, entropy comes in and then things go to disorder in any system. Physics teaches you that. There is the second law of thermodynamics that works out. And it works out in all systems. I mean, ultimately, physics is a substrate of everything that you are doing. If you don't understand those laws, I can give you an example. The first law is entropy, if you ask me. The third thing we try to understand, I mean, the next steps we are trying to understand is management. That's an ecological viewpoint. Competitive. Where is the niche? And is it able to defend that niche? If it can't defend that niche, that ecological niche that it is working in, then it can get killed. There are predators who come in, and these are species that come in, they can destroy. And there's no point. You're looking at nature, and nature has shown you this over and over again, including our markets have shown you this over and over again. What they we won't want to know is the quality of the management. The quality of the management we gauge by the efficiency with which they're managing capital. Whether they have certain principles that they follow, there was certain adaptability in the management. And I can't expect to find 100% honest management, but I don't want to be near crooks. And crooks would mean people who don't necessarily hold your interest primarily. I mean, look, you can make a lot of money even with crooks, but I don't think we have the stomach to make money with people whom we don't understand. So that's another filter. And there's a degree of subjectivity, who's a crook and who's not a crook. Because in this system, you have to even survive in the system. And survival sometimes requires you to do things which are not 100%. It's practical to accept that. But we don't
Yeah.
want to deal with such people too much. There are better options. And so the degree of everywhere, it's a degree. Because first, it's our own misunderstanding of what may be there. And two is that nobody can be sure about the future or about what's going on. How sure can you be even about your friends? You can't be sure. You can only put a degree of subjectivity that I think I'm reasonably sure. I'm reasonably, but you cannot say 100% that he's this, he's not, he may not be. So
Yep.
I think that's where we come down to. We put in degrees of, should I say, of uncertainty into everything, layer it. And we don't want to give high marks. Either we have not understood it and we are therefore not doubtful, and we may pass a big opportunity because of that. But functionally, that is the sort of system that gives us a certain amount of, and we will revise it. And if we find things that do not validate our thesis, events that start giving us a feeling of discomfort, and if we find some better opportunity, we will go near that. I mean, I'm talking about the active management part. The passive management part is like sleeping. I mean, I've got this thing armchair over here. Sleep most of the time. I don't do much in terms of trying to find the next thing to be.
Of course.
Giving me a 14-15% rate of return, which is not great. I could be far more active, but then I have to contend with taxes and I have to contend with a whole lot of things which I don't want to get. So I'm quite happy to be very passive because I have decent capital and I'm happy with what I have. With what you're doing, objectives you set yourself.
I think these are some great checklists, basically understanding of the business, the efficiency of capital that you talked about, the quality of management, especially coming in from the fact that whether you can defend the niche or not, how do the management...
Your standard, any asset manager will have this sort of a checklist. The question is, how we apply it? I mean, and how much you debate and argue. It's easy to fill in a checklist. The question is, how realistic is it?
So you have an incredible background, Wharton MBA.
Actually served against me because being a Wharton MBA meant developing a lot of blind spots, which had to be regarding with efficient markets, capital asset pricing models. All that had to be thrown into the dustbin. It was an investment of time, effort, and money which had to go to the dustbin because they don't work. Literally, they don't work, at least for somebody. There are basic elementary philosophies which are very simple if you know how to apply, which unfortunately cannot be reduced to equations. And that is what I have a lot of pride for what I've worked at Wharton. There are a lot of things in junk also, and a lot of finance I had. But there were some amazing finance professors, so I don't get me wrong.
No, absolutely. So, which is exactly what I want to get to is like for wealth managers and investors, like who want to break out of this rigid linear thinking. Like, what are the first 2 or 3 non-finance books they should pick up and force them to read, right? And why?
3 names. One is, these are by Hushman, he's no more there. I'm a big fan of Hushman. And he teaches you to think non-linear. If you're an economist, he talks about a whole host of subjects. So he talks about reactions arise. So anything that goes, there's a huge reaction that's always there. And you can call it reactions that come second order effects. You can give it different names, but ultimately there is a reaction. So to expect progress without any reactions is something. It just makes you realize that you have to think not what can go wrong, but what can work against it. And it's a thesis and antithesis, which have to be simultaneously in your mind. And the other guy is who spoke in terms of nested systems. He's also an economist. Kenneth Boulding is amazing. He is more than an author, he's a thinker, and a thinker who thinks in terms of systems. So I think that this is a book that comes from a book that Munger has recommended, which is this book, Scientists in the World and the Cause.
Right.
I think these are things you can read from outside finance. And that happens if you're not trying to watch the market. And if you have to do that as a job and as a living, then you better not read all those books because you won't have time to think or regurgitate this in your mind. If you are retired like me, or if you are a little bit away and you've built up capital, and you now want to manage your own money and you have time, if you have a philosophy which is long term, if it's trading, again, these books are not for you. It's just not necessary. But if you are an investor and you have time, and I'm talking about a patient investor, and you are intellectually inclined, that is also another requirement.
Of course.
These are the otherwise people say कि ये पढ़ने से क्या फायदा, then please don't go near this. It's not required. So
Amazing recommendations from you. I mean, whether it is Chishman, Kenneth Boulder for nested systems, I got Cartolina. So I would personally like an access to your library and maybe try and replicate
it's
some of
where
it. So
I don't think that move this enough. Let me see if I can move this to show you. This is just a small part of the library.
Wow.
Because
Wow.
my wife threatened to throw out all these books. He said this is cluttering up the house. So I just moved it. I have other places and I just collected it. I don't have a librarian, but I had someone who does keep a list of what books I have. But I don't think I can read all of them. That's the reason why I use a lot of AI to get some help in terms of
Sure.
being able to do my thoughts. So it's not mine again. It's not original. Nothing that I say is original. It is all from reading, writing, from learning, and what my own experiences have taught me. And I was very, very lucky to have had the right mentors from the beginning. I'm consider myself lucky.
Absolutely. So, Chetan, one final question from our side. I know we have taken a ton of your time, but if you have to summarize,
Don't worry about my time.
so, but if you have to summarize your entire investment philosophy in one sentence, right? I mean, what would it be? I know it's very hard, but would love
I
to,
thought about
kind
it. I
of
thought about
conclude
if you
with that.
asked me this question 25, 30 years back, I would have said that margin of safety and invest within your circle. The things that Buffett has written about. And I agree with all that today. But I would now, I think one has to evolve. And I would now say that go a bit more by what Mr. Munger says. So, you have to be like Charles Darwin was a naturalist who used to observe the ecosystem. He used to learn from the ecosystem to actually make theories or to make observations. I think that you've got to be a naturalist. You have to think you're in an ecosystem that is changing. And if you've done ecology or if you read about ecology, you know that extinction is a fact of life. If there is extinction, there is a thing known as trophic cascades, which are when the entire ecosystem changes, when a predator or a keystone species is knocked out. So I think that the thing is when there is creative destruction, when there is this sort of change that is happening, be a naturalist. Think like a naturalist, but have very strict discipline on capital allocation. That whatever Mr. Buffett has said on capital allocation was good. But be a naturalist. Be prepared to change your mind and change your mind not very fast, but after recent thought, you should be able to change your mind because the times that are coming are times that have happened. The times that are coming will not give you the luxury of very, very long-term time horizons. You may have to shorten your time horizons. You may have to think in terms of optionality. You may have to think in terms of looking at a different set of, I'm not saying about asset values, so that still remain, but I'm saying think in terms of options and options which you can actually think through by looking at what sort of business model can evolve. Nobody knows for sure what will happen, but you have certain things from complex adaptive systems which talks about path dependence, which talks about those early modes, but these are lock-ins. These things create lock-ins. If such systems come to play, and who knows what will come when we intersect biology, bioinformatics, who knows what else human cells are going. I don't know. I'm just saying that look at options, look at the sort of stuff that can come out. And if it still meets if you think you're not paying too high a price, then maybe take that bet fully prepared that you may have to revise your mind, revise your viewpoint very fast. So you need a personality for that. I don't have that personality. I cannot be that hyper. I cannot be hyper. I'm not made to be hyper. And many people are like that. They're not made to be hyper. I cannot do that. So I'm lucky I lived through that period. The period ahead is going to be extremely challenging. And I can tell you, evolutionarily, I would have been a misfit for that system. Completely a misfit for that system. So I'm happy I did live when I did live. Now the times ahead are different. I am the first to acknowledge it. So whatever I'm saying is with the historical thing, what comes in the future may be subject to change. revision. I don't think the big ideas are going to be subject. The mental models are going to be, how we interpret those models will definitely be.
Chetan, I mean, I can't thank you enough.
No,
I mean,
can't
for this.
understand. But they give me a chance to think about what, because frankly, if I read and without thinking, with the questions you've asked, I mean, I must congratulate Manisha for the sort of questions you set out. I think that's very, very good.
Yeah, and this has been a very, very different type of conversation, honestly, Chetan. I mean, it's very, very inspiring. I think the way you bring in all these multiple disciplinary and all the examples that you talked about, whether it was around entropy, whether it was around keystone species, and applying it to the world of finance and the uncertain time that we probably would live in the future, and then how you can adapt and survive in that environment. I think it's truly inspiring. And as I mentioned, would love to get access more to your time and to your library.
Most welcome. Please come over. You're most welcome. Let me know. I'll be glad to take you through what I have.
Absolutely.
I have different location also. My team just sits with books around them. They don't read it, but they have that bookish background. Yes, they have to go out more in the field. That's what I told them. Be also like anthropologists. Unless you go out in the field and do field studies, you will not be able to have a clue. So they do go out in the field. They have to go out in the field and become, in a way, like anthropologists.
Lovely. So much to learn from you, Chetan. Once again, thanks. Thank you for doing this for us, and thanks for your time. And then we'll be in touch.
It's a pleasure. Thank you so much.
Thank you so much.